This week we move into what I call the 6-month unfavorable period for the stock market, which lasts from May 6th until October 27th. In this period for the stock market, it doesn't mean the stock market can't go up. It can. But on average, over the long term, in this 6-month period, the stock market doesn't do as well and hasn't produced large rallies in the stock market above 10% unless we've seen some bounce off recessionary conditions, which is currently not the case for the economy. Also, too, as well, over the next 6 months, we tend to see, on average, over the long term, larger drops in the stock market. So it's the time to be a bit more cautious. But there are opportunities both in the stock market and the bond market. So today I'd like to take a look at the U.S. government bond seasonal opportunity, which lasts from May 6th until October the 3rd. Now, the sweet spot to the trade where bonds have done particularly well is over the long term has been August and September. But we still are in that seasonal period where government bonds tend to do well. I'd like to take a look at, in this case, I'm taking a look at the yield on the 10-year Treasury note. So as the yields are coming down, bonds go up in price and vice versa here. So once again, this is the yield on the U.S. 10-year Treasury note. You can see here back in 2010 that the yield got down to 1.5%, which is like at the time, I remember the narrative that everybody's discussing the bond market's over, yields can't move lower for the 10-year below 1.5. That's just crazy. And sure enough, yields ticked up here after that, and bond prices went down. And then once again in 2016, we saw yields get down to 1.5%. And the same narrative took place. Then we saw this rally in yields, which means bond prices went down. In 2019, we saw once again the yield get down to 1.5%. And in 2020, we've seen the yields actually decline since the beginning of the year as the Federal Reserve was cutting rates and expressing a very loose monetary policy. And we've just knifed through this 1.5% for the 10-year Treasury note on the yield. In fact, right now, we're down to 64 basis points, which is crazy. I mean, it's ridiculous. But the Fed can actually force this to be lower, as the Japanese have done with their yield curve control. And we can't guess what the Fed's going to do. Maybe they do this, maybe they do something else. They're doing some crazy stuff that they've never done before. And they've said, you know, we've got lots of tools we can use to help support the market. So we can't really judge what the Fed's going to do. But we have to look at this really from a technical and a seasonal perspective specifically. If we take a look at, in this case, this is a closer viewpoint on the yield of the 10-year Treasury note. You can see here that we've had lower highs all the way down take place. And this has really formed what I call a descending bearish triangle. And it typically, in technical terms, resolves to the bottom. So you've got downward pressure on this movement here, which says right now, technically, there's support for the yield to move lower and bonds to move higher. So how does that translate into the bond market itself? In this case here, I'm using the ETF in the States, that trades in the States, the iShares 7 to 10-year government bond ETF, IEF. And you can see here in 2020, we've seen this rally take place with government bonds as interest rates have come down. And so the stock market did really well at the beginning of the year, and so did the bond market. And it's interesting to see the strength of the bond market when it typically doesn't do well, because the Fed's usually not cutting rates as much as it did at that time of the year. But what's interesting is we formed, before I talked about what was called bearish descending triangle, this is actually a bullish ascending triangle. So what we've got here is we've got higher lows taking place all the way across, and here we are at the ceiling for government bonds here. But we've got that support from rising bottoms taking place, which is actually quite bullish for the overall bond market. Despite the bonds having rallied quite strongly here, they still can move higher from this point. So from a seasonal perspective, we have a good picture for government bonds, and also from a technical picture, we have support for bonds to move higher at this time. Thank you very much.